we come in every day and we put forward the new risk. We talk often about tail risks. What is the biggest tail risk in the US-China debacle that shifts the market like it did in 2015 on currencies, like it did in 2013 on bonds? What's the biggest tail risk?
So I think the issue is that, all the machinations that we're seeing so far, you don't know how real they are, how scripted they are, how much playing to the audience there is. So the real risk is that this thing spins out of control. And I think we're already starting to see signs of that because, as you were saying to Juliet a few moments ago, one of our big concerns at the moment is tech valuations. And tech seems to be caught up in the crosshairs of this of the standoff that's going on right now. So if the whole thing spins out of control, does that really highlight just how crazy some tech valuations have got, just how financialized the whole tech sector has become? And if we start to lose tech leadership at this rally, what does that do for the broader market?
I mean, Paul, we'll get into some of the U.S.-specific calls shortly, but in terms of havens, in terms of hedging potential risks from the U.S.-China spat, gold, silver have had, that is one jaw-dropping rally by any stretch of the imagination. And you're saying, you know what, it's time to get out of that trade. But where else would you be able to lock in a haven-like trade? If it's not gold at this point.
Absolutely. So that's the real problem right now. That we've had a pretty good year so far, and that's been because there's always been somewhere good to go. At the start of the year, defensives were good value, gold and treasuries were pretty great value. They spiked as everything else turned bad, so it became a fairly easy rotation out of there. Then when stocks started to pick up, China stocks, emerging market tech, China tech still look great value, as I've been banging on about for months. But the problem is we've now had a really crazy everything rally, and there just doesn't look anywhere to go anymore that looks like decent value. You can't find anything. Gold looks very vulnerable to a correction if we get good news. Treasuries are certainly vulnerable to a reversal. So in that situation, it's really hard to see anywhere to go, and it's really hard to see anywhere giving those kind of defensive properties right now. We could easily see a situation where rates start to look as if they're going to tick higher. That also punctures the gold bubble. That also punctures the equity bubble. So we having seen an everything rally, the corollary to that could be an everything crash, and that's what really worries us. Which is why we've really increased weightings in cash right now. When everything else looks bad, cash, which is neutral, looks relatively better.
Okay, I think we should just probably lock up shop and go home then. You played to my inner Grinch. I started the show with junk, careering towards record lows. Treasuries, record lows. If that kind of risk that you're talking about is a real risk, then talk me through the potential. I asked this yesterday. In the taper tantrum of 2013, bonds re-rated by 140, 150 basis points. In the scenario that you're talking about there, what's the repricing potential in junk and in U.S. sovereigns?
Well, junk could go way below the March lows that it hit. That's really vulnerable. I don't see any justification whatsoever for holding any junk or any high yield at these prices. That just makes no sense. There's so little upside, and there's potentially unlimited downside. People who are buying that don't know what they're buying, in my view. It's a bad version of equities. If you look at sovereigns, I think there's a real risk that we're going to see a pullback in U.S. sovereigns. If that happens, we'd be a buyer again. We had a position of 20 to 25% in a lot of our portfolios in treasuries not so long ago, just a month or so ago. That's now been cut back to 5 to 10%. We'd be pretty keen to be a buyer if we see a pullback again, very much at the long end, because that's the only way you can make or lose money in treasuries these days is at the long end. So if we start to see the long end rising, then that's a chance to buy. But right now, that long end is so vulnerable to a correction that it certainly doesn't have the hedging facility that it did previously. It doesn't offer that, and it's as you were just saying, as Yusuf was just saying, it's very hard to see anything that hedges risk at this stage, which is why taking risk off across the board looks sensible.
Yeah, that might be the case. And you're saying, you know what, go into cash, but then I have to deal with a potential increase in inflation. I leave quite a vulnerable portion of the portfolio, up for grabs effectively. How much cash in your portfolio do you leave then? Is it 30% or is it 40%? What does an increase in your cash component look like?
So it's gone up from virtually zero to about 25%. But I think the one thing that still remains interesting in this environment is the fact that there is still so much dispersion out there. There's still so much, differential between sectors, even between companies within sectors. And therefore, the one thing that the only thing we haven't really been paring back is relative value and long short strategies. And long short is having a pretty good year. And if dispersion continues, despite the market direction, you'd expect that long short would continue to do well. It did well. It did okay in February and March. I don't see any other way of approaching equity markets except through a long short or a relative value basis right now.